This lecture is going to be another lecture in the Mining Stock Education and Resource Stock Education lecture series. So this lecture will cover the three most common ways and go into some detail with some case studies about how mining companies and also oil and gas companies fool investors. So hopefully people who pay attention to this, if they decide that they want to go buy individual mining stocks or individual oil and gas producers, hopefully they will not be one of the victims, because there are a lot of lawsuits out there right now from pension funds, from mutual funds, against these shale oil and shale gas companies. So before I go into some more detail, let me read some quotes from the CEO of a large drilling company, EQT, Eric, Q is in quiche, T is in Tom, his name is Steve Schlotterbeck, and he gave a speech at a petrochemical industry conference last month in June 2019 in Pittsburgh. And he had a blunt message about shale gas drilling and fracking. Quote, "The shale gas revolution has frankly been an unmitigated disaster for any buy and hold investor in the shale gas industry, with very few limited exceptions," end quote. So he continues, he left the helm of EQT last year. He continues, quote, "In fact, I'm not aware of another case of a disruptive technological change that has done so much harm to the industry that created the change," end quote. Quote, "While hundreds of billions of dollars of benefits have accrued to hundreds of millions of people," and I'm guessing he's talking about lower prices and more people having access to natural gas, lower gas prices, lower natural gas prices. The amount of shareholder value destruction registers in the hundreds of billions of dollars, end quote. He said, quote, "The industry is self-destructive," end quote. So he is not the first industry insider to ring alarm bells about the shale industry's record of producing vast amounts of gas while burning through far more cash than it can earn by selling that gas. And Driller's own numbers speak for themselves. Reported spending outweighed income for a group of 29 large public shale gas companies by $6.7 billion in 2018, bringing the group's 2010 to 2018 cash flow to a total of negative $181 billion, according to a March 2019 report by the Institute for Energy Economics and Financial Analysis. So he's also said that an average of 80% of the value of the companies were destroyed. And that negative cash flow, a total of $181 billion over 8 years for shale gas companies. I've seen a similar report about shale oil companies. There was, let me pull it up. I have a bunch of articles open. There was a report that was done by, I think, the IEA. Let me see if I can find it. See if this is the right one. Okay, yeah, here we go. Wait, that might not be the right one. Oh, I thought that one was it. Okay, give me another second. Okay. The International Energy Agency estimates that the U.S. shale industry, the oil producers, generated cumulative negative free cash flow of over $200 billion between 2010 and 2014. I was on the right article. I was just looking in the wrong part. So, and the numbers are even larger than that. So over $1 trillion of investor capital, a lot of it has come from pension funds. And remember, I talked recently about how a lot of pension funds were raped and pillaged. One of the main things recently over the last decade that pension fund money has been raped and pillaged on is shale junk bonds and shares of U.S. shale oil producers, who promised them earnings, who promised them good margins, who promised them free cash flow, who promised them dividends. And guess what? Most of the companies did not deliver. Almost all the companies did not deliver. There's EOG, which is a very well-respected company, and very few other shale oil companies have delivered on that. Basically, for the first 10 years of U.S. shale oil, even when oil prices were high and the shale oil companies' costs were coming down, they still did not deliver earnings, consistent earnings, and consistent free cash flow. So the industry, while the U.S. has a lot of oil production, that oil was not produced efficiently. Some people made some money, but most people did not. The long-term buy and hold investors, the full cycle investors who bought and hold those shares, they lost big. So I'm going to do in this lecture, I'm going to talk about how it is extremely common still for many mining companies and many U.S. shale oil companies to underestimate their real costs. So since I'm talking about shale oil first, let me just go into detail about that. So I have a good amount of friends now in the oil and energy industry. I've interviewed some of the smartest people in the United States in oil and gas, some of the best analysts and experts like Art Berman and Dr. Kent Moores and Robert Rapier. I even worked with Robert Rapier for about a year. So I have a background as an energy analyst as well. And when you talk to some of these oil people, not the people I just mentioned, but I'm talking like people that are always bullish oil, always want to go out and drill, always want to raise capital, always think the oil price is going higher, even when the oil price is collapsing. They will tell you, unfortunately, and these are smart people, for a bunch of different reasons, they just want to believe that the oil industry can produce oil at super cheap costs and make tons and tons of money, especially these shale producers. So one of the most common things I hear from shale producers is, and the energy analysts say this, is that it's only 10 or 20, at most $30 per barrel to get the oil out of the ground. Well, if that were true, the financial statements would reflect a financially robust company with far better margins that was generating free cash flow and would have a lot better balance sheet. And then also that capital, after free cash flow and cleaner balance sheet without debt and not having to go back to shareholders to raise more equity, that capital would be returned to shareholders in the form of dividends. Or if the stock was cheap, maybe management would use free cash flow for share buybacks. And in the shale industry, a lot of that has not happened. So the figures that are quoted, and unfortunately, if you go to an investors conference or you look on a shale company's website still, you will still see them claiming that their costs are low. $10, $20, $30. If you go to a hedge fund or investment bank conference for oil and energy, you will see a lot of shale oil producers claim that they can produce oil for $20 or $30 a barrel. Well, their financial statements are not reflecting this. But they're claiming these low costs still to try to raise capital because they always need capital. It is very capital intensive, very high Capex to drill and to produce shale oil to maintain production levels. Shale oil is a scam of the bankers. No, I don't know if it's a scam. It's just not economic like they promised. The U.S. needed the oil production, and shale oil is a scam of artificially cheap interest rates. When the central banks decided to manipulate interest rates lower, you had desperate people like SEC accredited investors who wanted income, or pension funds or mutual funds who wanted a guaranteed 6 to 8% return, so they took the risk of financing junk bonds. Well, that's interesting there in the comment section. But so let me continue on with shale oil. So the cost for shale oil, the lifting costs that are quoted, so the $10 or $20 or $30 per barrel, that is just the cost at the wellhead to get the oil out of the ground. It does not include a bunch of other costs. Sometimes it only includes about a third to a quarter or a half of all costs. Sometimes it's a lot less than a half of all costs. So it does not, when you hear that number of lifting costs, it does not include transportation cost. It does not include cost of capital, which is cost for the shale oil company to borrow capital, either debt or sell shares or equity or other financing, maybe on their revolving credit facility or sell bonds or whatever. There's different ways a company can raise capital. It also does not include, and this is important, a lot of resource industry companies like to give figures that do not include everyday expenses that every business needs, called SG&A, selling, general, and administrative expenses. So by the time you're adding in all these costs, like transportation cost of the oil, if the oil is nowhere near a major pipeline, you have to use trains, or you have to, it's very expensive for water cleanup. There's a lot of other added costs that go into it. Oil still has Capex, but not quite the amount of maintenance Capex that mines require, but it's still a capital intensive business. And so when you're underreporting all these costs, and some of these shale oil companies are drastically still underreporting all their costs, there is no all-in sustaining cost metric yet for the oil industry, you're going to run into problems. Hedge fund manager David Einhorn in 2015, he was talking about the problems. Now, he wasn't right on his stock picks for shorting some of these, but he was right about the accounting grievances. I have articles about this, and he did a presentation at a hedge fund conference about this in 2015, I believe. Jim Chanos also talked about this in 2017. There's a CNBC article I have about this, and he is saying, let me see here if I can find our quotes. He is saying that, quote, in our view, people have been looking at this industry through the rose-colored glasses of Wall Street, and this is an inherent problem with North American shale business. Drillers' persistent and unfulfilled promises to generate positive cash flow, especially as oil prices remain... Okay, oil prices have, they did rise and now they're falling again. But the oil price in general is extremely volatile. So Chanos remarks add an influential voice to the chorus of skeptics. Chanos, who foresaw the spectacular downfall of disgraced energy titan Enron, is renowned for scrutinizing accounting methods and spotting trouble on the horizon. So he is not always right, but he is right a lot. And normally over long time frames, Chanos is right a ton. He is right way, way more than he is wrong over longer time frames. So Chanos looked at about 36 drillers and found that their capital spending would eat up almost all of their earnings minus certain expenses in 2017. That leaves them with little cash to service their debt. And then he asks, see the problem? It's a big one. So drillers have reduced the amount of capital they need to produce the same amount of oil, but not enough to make many of them profitable, he said. Chanos believes that capital spending is essentially a variable that creates a vicious cycle in the oil patch. So if you want to read more of this article, I'll attach a link to it. But there's been big warnings about shale oil from David Einhorn and Jim Chanos, who are two of the smartest people in finance. They're not always right, but I think they're giving fair criticism, and they're definitely highlighting big discrepancies in accounting. The mining companies, I've talked about this at length. And when you underreport your costs, you are fooling investors that you should have profits, you should have margins, you're doing it to make it easier, you're intentionally underreporting your costs, and the mining industry has gotten better at this. So it is not to the egregious levels in most cases that it was prior to the all-in sustaining cost metric. I would still say a lot of miners are still underreporting their costs by about 20 or 30%, but it is not to the 50, 60% or more levels of underreporting their costs that it was 5 or 6 years ago. And I talked about this in a previous lecture about the history of the all-in sustaining cost metric. You can go back and listen to that more. So when you underreport your costs as a resource company, you are lying to your investors. You're lying to pension funds. You're lying to mostly retail people or not as sophisticated investors that you are very profitable, that your balance sheet is going to be better, that if you borrow debt, you can pay it back quicker. And in reality, what we know in hindsight now, because the shale oil industry has been around for a decade, that is not true. So the shale oil industry has lowered their costs, but they have not lowered their costs enough to be consistently profitable, at least most of the companies. So I have an article here from Art Berman about the oil reserves being grossly exaggerated. So the first major of the three ways that mining companies and shale oil companies fool investors is many of them understate their costs. And there's a lot of reasons why they do this. They pretend to be in better financial shape. They pretend to be able to generate better margins. They pretend to be able to generate more free cash flow. And this is done so management can stay, doesn't get fired, management can raise capital, but you are seeing more and more lawsuits against shale oil companies against this. The other thing, and this is more common from my research with U.S. shale oil companies, is reserves. So mining companies tend to not really lie on their reserves. Now, junior miners will overestimate stuff on their economic assessments, like a preliminary economic assessment, a pre-feasibility. Those tend to not to have bad assumptions in there and not be as accurate as a feasibility study or bankable reserves. But the shale oil industry, and David Einhorn has highlighted this, and other hedge fund research has, there's a great book out. If you have 4 hours, there's a audiobook by Bethany McLean. She is a investigative reporter, a financial journalist, one of the best ones left. And she helped find the fraud in Enron, along with Jim Chanos. And she wrote a book last year that came out in September last year called Saudi America, The Truth About Fracking and How It's Changing the World. And so I highly recommend that audiobook if you have about 4 hours. It's available on Audible. I found it very interesting. I finished it like 5 or 6 months ago. And in there, she talks about how some of the shale oil producers were egregiously, well, it's just egregious levels of fraud, were egregiously lying to investors on their investors' presentations. So if you're not that savvy of an investor, you're just learning how to do this. Normally, when you're starting to do due diligence on an individual resource company or any company in general, you go to the company's website, you look at the investor's presentation, you look at the quarterly reports, the financial statements there, the annual reports. Well, and then also the management discussion and analysis section. I don't know if oil and gas companies have MD&A, management discussion and analysis, but mining companies have that now. And then you try to get a gauge of where the company is, what their financial statements are, what their costs are, how profitable they are at current metals prices, what growth plans they have, how undervalued they are relative to their peers, etc. And the discrepancy that came, and this is fraud, and this is why a lot of shale oil companies are being sued, besides underreporting their costs and promising profits and better margins and free cash flow and dividends to investors like pension funds and other investors. The other main reason that shale oil companies are being sued is because there were enormous discrepancies between their listed oil reserves on their investors' presentations on their website, their annual reports, and those documents there versus their SEC filings. So David Einhorn highlighted these discrepancies about 3 or 4 years ago, and so I'm sure there were a lot of lawsuits filed then, but there's even more now. And there was, in some cases, some of these U.S. shale oil producers, some of these companies were the discrepancies between their reserves that were listed in their investors' presentations, the PowerPoint on their website, versus their SEC filings, they were overstating their reserves by 8-fold, sometimes more. Not all shale oil companies were doing this, but some of them were. So this is a big red flag. So I would say that problem number 2 of overstating reserves is far more common in U.S. shale oil producers, because the one thing about shale oil is that a lot of the production is front-loaded, so you get your cash flow right away on the well, but it is very difficult to maintain production levels for shale oil. So you have to spend more and more Capex to maintain production levels, and a lot of the sweet spots in the shale patches have already been drilled. And finally, the third part here is many mining companies intentionally don't tell or warn their investors that a massive Capex bill or capital expenditure bill on a producing mine is coming. And this is where investors and also the mining company itself can get in trouble. So some of these mines could be really, really good. I've talked about Yamana Gold and their Chapada mine. That was a really good low-cost copper, gold, and silver mine for Yamana Gold. But Yamana was not so good at telling their investors that, because they were telling their investors that this is a cornerstone asset. They've been telling them this for years, up until they announced that they were selling Chapada for $800 million to Lundin Mining. That they planned on keeping Chapada because it was their best margin, lowest cost producing mine, and it would be a cornerstone of the company. The reserves are very long-lived for many years to come. By the way, Sandstorm Gold has a copper stream on there, and I believe there may also be a silver stream that might be sold once Lundin Mining fully acquires the mine. I'm not sure if the transfer has occurred yet. So I think one of the main reasons that Yamana Gold sold that mine, the Chapada mine in Brazil, it's not because they didn't like the mine. It's because they couldn't afford the Capex bill. So there was like a $230 or $240 million Capex bill that was going to have to be paid in the next 2 or 3 years, and Yamana Gold didn't have a good enough balance sheet to afford the bill. This is the same reason that Yamana Gold is going to have to sell probably their entire stake in Agua Rica, which is the economic assessment just came out. I think it's the pre-feasibility just came out for Agua Rica. And you have Newmont Goldcorp and Glencore, who are also partners in Agua Rica, and they want that project fast-tracked. Well, Yamana Gold is responsible for 50% of the Capex on Agua Rica, which is a $2.4 billion total Capex bill as of now. We'll see what the feasibility study says. The feasibility study is supposed to be out, I think, by the end of this year with updated project economics. But if the numbers are similar or the same when the feasibility study comes out, Yamana Gold would have to pay $1.2 billion, the 50% bill of the $2.4 billion in Capex, and Yamana can't afford it for that new mine, the Agua Rica mine. So they're going to have to sell it. They're going to have to sell it to a larger copper miner or a larger gold miner. They can't hold the mine because the other mining partners that they're partnered with, they have a new partnership agreement with Newmont Goldcorp and Glencore. Those guys want the project fast-tracked. There's a mine next door that's already producing that's low on reserves, and they want that mine done. So mining companies, and this is where buy and hold investors of an individual mining stock can get really, really into trouble, is if they buy and hold a company and they don't pay attention to the company, and then they think that there's a low-cost mine, and then all of a sudden the management team realizes that there's a very big Capex bill coming due. There is an excellent business book that talks about this. It's not a resource stock book in particular. I've talked about, for business books, Buffettology. I think Buffettology is one of the best business books out there. It doesn't have that good of ratings, but it really allows you to put all businesses into 4 categories. But this book is, it's out of print now. It's by a famous value investor and a hedge fund manager, Seth Klarman. The out of print book on Amazon is over $1,000, and it's in the libraries of a lot of famous value investors, but you can get the PDF online for free. So you can download the book. It's called Margin of Safety. And in the book, Margin of Safety, it talks about mining stocks and resource stocks and what can get the mining company and resource company into trouble. And it's all about the main thing that can get a resource company into trouble is maintenance Capex, is those unexpected or delayed bills that come due of enormous amounts of money. If it's a small mining company, 70 million, 100 million. If it's a large mining company, hundreds of millions of dollars on a mine. So the mine could be making the company a lot of money, and then all of a sudden, this enormous bill comes due. It's like if you're with your family, if you have an emergency and one of your kids needs like $10,000, $20,000 surgery, and you don't have a lot of money in savings, and your credit card bills are already, your credit cards are not in good shape. You haven't paid them off. So the mining companies are like that in a lot of aspects. So a lot of due diligence is required if you're going to own individual mining companies. Otherwise, there's certain paid investment newsletters. A lot of the paid investment newsletter companies, though, do not really cover mining stocks anymore. I get emails all the time. I think Jordan asking about which paid investment newsletters are good. I think Jordan Roy Byrne at the Daily Gold is very good. I think he does a combination of fundamental and technical analysis. I think he's good. And most importantly, last time I interviewed him, he put his own money. He had a $100,000 mining stock portfolio. So if he screwed up, guys, he was going to lose a lot of his own money. I'm not sure if he's still doing that, but he was doing that a couple of years ago. So he was putting his money where his mouth is on his own stock recommendations along with his listeners. So let me check to see if I covered all the stuff I wanted to cover. So to summarize things, the three main ways that resource stocks, mining companies, and oil and gas companies fool investors is, number one, this is pervasive in both industries. It is not as bad in mining, in primary gold and silver miners, as it used to be, but it's still about 20 or 30% understating of costs. For the U.S. shale oil producers, it is even worse. Some of these shale oil producers, guys, are understating their costs by more than 60%. Some of them. So when you understate your costs, you're pretending to be profitable. You're trying to make it easier to raise capital. Management is making it like they're doing a good job. The reality is much, much different. Number two, the second most common way that mining companies and oil and gas companies fool investors is overstating their economic reserves. And this seems to be most common in shale oil companies right now. And I talked about the discrepancies. It's the details of the discrepancies are mentioned in some of these articles that I talked about. David Einhorn and other hedge fund managers talked about it in their presentations. The discrepancies versus the shareholder material on the website and in the financial statements on the website versus the SEC filings. And also in Bethany McLean's book, Saudi America. She goes into this at length too. It's only 4 hours long. Good audiobook. And the third one is the Capex bill. So shale oil companies have very large Capex, and most people are aware of this. But mining companies, a lot of people who invest in individual mining companies are not aware that basically out of the blue, the mining company could look like it's in good shape. It could have a couple good mines, some diversified cash flow, and a couple good mines that are producing gold or silver at a good margin. And then all of a sudden, here comes a $200 million or more Capex bill that has to be paid in the next year or two. And if the miner doesn't pay it, the mine is going to be in trouble. So the mine's going to go from a cash cow to a anchor, to a big economic burden. So if you want to do more research and due diligence on this, I have articles, like I said, from Art Berman. I have an article about the U.S. shale has a glaring problem from November 2nd, 2018 by Nicholas Cunningham. And I have a couple articles about David Einhorn, what he said about shale oil, and Jim Chanos. So I think that's pretty much it for this lecture. I think I've covered it fairly well. And those are the three main problems, and they're very overarching. So I'm doing these lecture series to help people who are buying individual companies rather than exchange traded fund, or are not willing to pay for research. And also because I want the industries, both the oil and gas industry and also the mining industry, to reform. I want transparency. If you have good costs, be honest. Show them itemized. If your all-in sustaining cost is really $10 per ounce for silver, show every single cost itemized. Prove it. If you're producing shale oil, if you're the lowest cost shale oil producer in the United States and you're producing shale oil really at $30 per barrel, show your itemized costs. Don't just tell us your lifting cost is $10 or $20 and then we look on your financial statements and it doesn't match. So I would like to see improvement there. Unfortunately, there is a perverse incentive to not telling the truth. But then that is why you're seeing the lawsuits now in the shale oil patch. The name of the book is Saudi America by Bethany McLean. And the other book, I'll put links to. You can just Google Seth Klarman. He's a hedge fund manager, Margin of Safety. Now, you cannot buy the hardcover book, Seth Klarman, Margin of Safety, because there are very few copies. The book went out of print, I think, in 1991. And the book normally sells to private collectors like as a first edition antique book sale stuff for over $1,000. A lot of the most famous and richest value investors have copies of the book in their library. And Seth Klarman, in that book, he goes through detailing businesses like factories and other mining companies about maintenance capex. So a factory has to retool their factory sometimes for billions of dollars, like Ford and General Motors or other factory, or Boeing, every, 3 to 5 years. So that is added expense, and that hurts their margins, that hurts their free cash flow when you have to do stuff like that. The Tesla Motors people don't understand any of that stuff. The majority of Tesla bulls don't understand any of that stuff. The Capex bills that Tesla is going to have. And they don't have funding for any of their growth projects and maintenance Capex either, really. Okay, guys, well, that's it for right now, and I will attach links to a lot of the articles that I cited. Everyone have a good rest of your night, and we'll see what happens this week, because we have a Fed meeting coming up, and we'll see what the Fed decides to do. If the Fed does cut rates, in my humble opinion, the rate cut would have to do with the dollar and the currency war and trade war that has restarted now with the European Union. And because the dollar index was above 98 and it corrected a little bit, but the Fed does not want the dollar index staying above 98. The dollar index has, if you go back and look at a chart of the dollar index has failed to stay above 98 a number of times, a good amount of times in the last year. Okay, guys, that's it for now.